All right, let's dive into Google's latest earnings report because the numbers are just staggering. We're talking record revenue, a massive 33% jump in profit, and an absolutely insane spending spree on AI. But, when a company's profit grows more than twice as fast as its sales, you've got to ask, what is really going on under the hood? Let's find out. So first things first, let's look at the top line. For the very first time, Alphabet's revenue in a single quarter just smashed through the $100 billion mark. That is a 16% leap from last year, and it absolutely blew past what anyone was expecting. But believe it or not, that's not even the most jaw-dropping number here. Because this is where the story gets really, really interesting. Net profit, it didn't just grow. It shot up by a whopping 33% compared to last year. Now think about that. That's more than double the rate their revenue grew. And anytime you see a gap that big, it's a huge red flag that says we need to dig a little deeper. And that leads us right to the heart of this whole thing. How does that math even work? Where did all this extra profit magically appear from? The answer, it turns out, really shows you the two completely different sides of Google's story right now. The reality of its business and the story that's being told on paper. Okay, so let's put on our detective hats for a second and crack open this big profit number to see what's actually inside. This is where we get to separate what the core business is really doing from all the, let's say, accounting noise. So, to get this, we've got to understand a really key concept from the source analysis at BGBC, and they call it paper wealth. Think of it this way. This isn't profit from Google selling more ads or more cloud services. No, it's profit that only exists on a spreadsheet, all because the on-paper value of some other companies Google invested in went up. And you can see the two stories right here. On the one hand, you have that incredible 33% profit growth in the headlines. But on the other hand, when we strip out all the noise and just look at the core business, search, cloud, YouTube, the real profit growth was more like 22%. Now, don't get me wrong, 22% is fantastic, but that still leaves a pretty big 11-point gap. So, what explains that difference? Well, here it is. This is the culprit. A massive $12.8 billion gain. This one single line item is pretty much responsible for pumping up that net profit number and creating that gap between what we see and what's real. But what exactly is it? So here's the crucial thing you have to understand. This $12.8 billion, it isn't cash that came from selling actual products. It's what's called an unrealized gain. It comes from Google's venture capital investments. All it means is that the startups they put money into are now worth more on paper. So Google gets to report this as profit, even though not a single dollar of cash has actually come into the company. And this kind of gain, well, it's super volatile and tells you absolutely nothing about the day-to-day health of the business. So if the profit number in the headline is mostly just paper wealth, how do we figure out the real story? Simple. We follow the money. Let's shift gears and look at the cash flow statement, because that's where you see the true financial engine of this company. And boom, this is where you see the true power of Google's business. In just the first 9 months of the year, that net profit number was about $98 billion. But the actual real cash generated from their operations, over $151 billion. That huge gap shows an incredibly healthy core business that is just churning out real money at a scale that is almost impossible to wrap your head around. And as the original analysis puts it, this cash flow is the final litmus test. It just cuts through all the accounting noise, all the paper gains and losses, and it proves without a shadow of a doubt that the foundation of this company, search, YouTube, cloud, is a cash-generating machine of historic proportions. So, if Google is generating this much real cash, way more than its reported profit, the next obvious question is, right, where is all that money going? And the answer is, it's all going into a massive, company-defining bet on the future of AI. The logic here is pretty simple, but the sheer scale of it is just breathtaking. You've got the core business acting like a cash cow. Then, that cash is immediately plowed back into record-breaking capital spending. And all of that spending is about one thing: winning the generational battle for dominance in artificial intelligence. And here's the price tag for that ambition. In just the first 9 months of this year, Google has spent nearly $78 billion on things like data centers, custom chips, and all the infrastructure they need to power their AI models. To put that in perspective, they are spending at a rate of nearly $100 billion a year just to build the future. And yet, despite this unbelievable cash machine, the market still seems a little hesitant. What you're seeing here is the PE ratio, which is basically how much investors are willing to pay for each dollar of a company's profit. And as you can see, Google is trading at a pretty noticeable discount to its big rivals like Amazon and Microsoft. So why is that? Well, it's probably a mix of fears about regulation and real concern about the staggering costs of this AI arms race.
Okay, so let's try to pull all of these threads together. We've got this misleading paper wealth on one side, and then this unbelievably powerful cash engine on the other. How are we supposed to make sense of all this?
It really is a tale of two Googles. First, you have the cash engine. That's the mature, stable, and incredibly profitable core business. And then you have the AI Moonshot, which is a hugely expensive, super high-stakes gamble to make sure the company stays dominant for the next decade. Essentially, the present is funding a very, very expensive future. And this split personality creates three pretty clear risks you should know about. First is profit quality. If that venture capital market turns south, those paper gains can turn into paper losses in a heartbeat. Second, the AI arms race. All this insane spending is eating into the company's free cash flow. That's the cash left over after these big projects. And third, you've always got regulatory pressure just hanging over them, like that recent $3.5 billion fine from the EU. Which leaves us with the final and most critical question. We know for a fact that Google's core business is a fortress. The big unknown, and the key thing for all of us to watch, is whether that fortress can generate enough cash to win a war for AI supremacy that's costing them nearly $100 billion a year, with absolutely no guarantee of victory. That is the real story hiding behind all these numbers.